Deciding to sell a stock is one of the most critical decisions you'll make in the world of investing. When your stock price goes up, you may want to lock in your profits, but figuring out exactly when to pull the trigger can sometimes be confusing. Should you sell because the stock dropped and you're looking to limit your losses? Or are you holding out for a bigger opportunity? Decision to sell a stock is not just about when to sell, it's also about shaping your future investment strategy. Today, we're going to dive into the advice from one of the world's most successful investors, Warren Buffett. Over the years, Buffett has honed his approach to stock selling, emphasizing the importance of finding the right strategy. His decisions are always grounded in solid principles, focused on long-term strategy rather than emotional or short-term thinking. In this video, I'll walk you through 3 key strategies for selling stocks that can help you solidify your position in the market. Let's take a closer look at the lessons we can learn from Buffett's decades of investment experience. Number 1, cost opportunity. Warren Buffett's first strategy when it comes to selling stocks is opportunity cost. This concept refers to selling a stock in a company you've invested in to take advantage of another, potentially more profitable opportunity. Opportunity cost is something investors face regularly. When you sell your current investment to move into a new opportunity, you're essentially giving up the future returns of your original investment. This can be a tough decision because you can never be entirely sure what the future holds for your current investment. One of Buffett's strategies over the years has been to consider opportunity cost and sell his investments when he sees a better opportunity. In 1959, Buffett sold shares of a bank called Commonwealth Trust, which was performing quite well. But he realized the potential for growth was limited, so he decided to move his money into a company called Sanborn Maps. In this case, Buffett sold a relatively stable company to invest in one that had greater growth potential in the future. Opportunity cost teaches us the importance of selling at the right time and considering whether your current investment could be swapped for something more profitable. Applying opportunity cost. Please make notes of these sentences and topics since I am giving crucial gifted info right now. You should also consider opportunity cost. As an investor, you should always be asking yourself if there are better opportunities in the market. If a stock has gone up and you're making a profit, but you spot a better opportunity in another sector, it might make sense to sell your current investment and move into the new one. However, always keep a close eye on the market and don't overlook the opportunity cost of holding on to something that might be underperforming in comparison. 2. Declining business fundamentals. The second key piece of advice from Buffett is to sell stocks when the company's fundamentals start to deteriorate. This means the company's financial structure, management quality, or growth potential is no longer as strong as it once was. Buffett's experience over the years highlights just how critical it is to pay attention to the fundamentals. If a company's management starts making bad decisions, or if there's a significant shift in its financials, it's time to consider selling. One great example of this comes from airline companies. During the pandemic in 2020, Buffett sold his shares in several airline stocks. There was so much uncertainty in the industry, flight restrictions, reduced demand from customers, and so on, that it made the future of these companies very unclear. Buffett recognized that the fundamentals of the airline industry had weakened, and thus he decided to sell his shares. Sometimes the fundamentals of a company change, but you might still think the company is strong in the market. However, Buffett's strategy emphasizes selling when the core business characteristics of a company change significantly. Recognizing changing business fundamentals. When there are major changes in an industry, like a breakthrough in technology or an economic crisis, it will likely impact stock prices. For example, a major innovation in the tech industry or a shift in the economy might render old business models obsolete. New products or technologies can start to gain more value in the market, pushing older businesses out of the picture. In such a case, selling your current stocks could be a wise move. 3. Avoiding emotional attachment. Warren Buffett stresses the importance of avoiding emotional attachment when selling stocks. Investors sometimes form emotional bonds with the companies they invest in, which can make it harder to sell their shares. When you buy stock in a company, you may feel a personal connection to it. But according to Buffett, emotional decisions in the stock market often get in the way of smart, strategic choices. A perfect example of this comes from Buffett's ownership of Washington Post stock. He held onto shares of the newspaper for years, but over time, the market conditions and competitive advantages of the company began to weaken. And as a result, Buffett eventually sold the stock. This decision shows how letting go of emotional ties is critical when making a sound financial decision. For investors, another lesson here is to avoid emotional attachment to stocks of companies that are struggling. If the company's fundamentals are deteriorating rather than holding on out of sentiment, it's better to make a rational decision and sell. Investment portfolio and risk management. Buffett's strategy on portfolio diversification offers important lessons on how investors can manage their risk. He advises against putting too much weight in a single investment in your portfolio. If a stock makes up a large part of your portfolio, you might need to consider selling some of it or reducing your position over time. Diversification helps protect you from the volatility of the market. Warren Buffett's strategies for selling stocks are not just decisions based on market conditions. They are also about thinking long-term and acting strategically. By learning and applying Buffett's strategies, investors can find success in the market for the long haul. Ultimately, following the advice of investors like Warren Buffett helps direct you away from emotional decisions and toward making informed, rational moves. According to Buffett, when you see better opportunities, sell your stocks, pay attention to changes in business fundamentals, and avoid emotional attachment. By doing so, you can make more solid investments. If you want to hear more of Warren Buffett's advice, don't forget to like the video and subscribe. Dear Stock Market Warriors.